Welcome back to Simple Mind Space. Today's episode is all about the stock market, specifically focusing on ETF and stock market deep dive for beginners and investors. The stock market can be an intimidating place. There's so much jargon, so many numbers, and it's constantly changing. But don't worry, it's not as complicated as it seems. The concept of the stock market has been around for centuries. In the 1600s, the Dutch East India Company needed a way to raise money to fund their expeditions. They started selling shares of their company to private citizens. These citizens would then own a small piece of the company and would share in its profits. This was essentially the birth of the stock market. Today, the stock market is a global marketplace where companies can raise money by selling shares of ownership, or stocks. Investors can then buy and sell those stocks, hoping to make a profit. But the market is significantly more complicated than its original incarnation. There are many factors to consider when trading, and it's all influenced by human confidence. To truly understand what influences the stock market, let's break down some key factors. What is a stock? A stock is a share of ownership in a company. When you buy a stock, you're essentially buying a tiny piece of that company. How do companies make money? Companies make money by selling goods or services. They can also make money by investing in other companies or by borrowing money and lending it out at a higher interest rate. What is an IPO? An IPO, or initial public offering, is when a company first offers its stock for sale to the public. This is a way for companies to raise money to grow their business. When a company goes public, it means that its shares are now available for trading on a stock exchange. What is a stock exchange? A stock exchange is a marketplace where stocks are bought and sold. The most well-known stock exchanges in the US are the New York Stock Exchange, NYSE, and the NASDAQ. What is market value? A company's market value is the total value of all of its outstanding shares. This is calculated by multiplying the company's share price by the number of shares outstanding. What is supply and demand? The stock market, just like any other market, is driven by the forces of supply and demand. When demand for a stock is high, the price goes up. When demand is low, the price goes down. What influences the stock market? There are many factors that can influence the stock market, including company performance. If a company is doing well, its stock price is likely to go up. If a company is doing poorly, its stock price is likely to go down. Economic conditions. When the economy is doing well, people are more likely to invest in the stock market, which can drive prices up. When the economy is doing poorly, people are more likely to sell their stocks, which can drive prices down. Interest rates. When interest rates are low, it's cheaper for companies to borrow money, which can lead to higher profits and higher stock prices. When interest rates are high, it's more expensive for companies to borrow money, which can lead to lower profits and lower stock prices. Government policy. Government policies such as taxes and regulations can also affect the stock market. Investor sentiment. Investor sentiment, or how people feel about the market, can also play a role in stock prices. For example, if investors are feeling optimistic about the future, they're more likely to buy stocks, which can drive prices up. How do you invest in the stock market? There are a few different ways to invest in the stock market. You can buy individual stocks. This means that you're buying shares in a specific company. This can be a risky investment, but it can also be very rewarding if you choose the right stocks. You can invest in mutual funds. A mutual fund is a basket of stocks that is managed by a professional. This is a less risky way to invest in the stock market, but you'll also pay a fee for the professional management. You can invest in exchange-traded funds, ETFs. An ETF is similar to a mutual fund, but it trades on a stock exchange like a stock. This means that you can buy and sell ETFs throughout the trading day, which is not possible with mutual funds. What is the difference between mutual funds and ETFs? Mutual funds and ETFs are both types of investment funds that pool money from multiple investors to invest in a basket of securities. They are similar in many ways, but there are also some key differences. Mutual funds pricing. Mutual funds are priced once per day at the end of the trading day. This means that you can only buy or sell shares of a mutual fund at that price. Trading. Mutual funds are not traded on a stock exchange. You can only buy or sell shares of a mutual fund directly from the fund company. Management. Mutual funds are actively managed, meaning that a professional fund manager is responsible for choosing the securities in the fund and making trades. Fees. Mutual funds typically have higher fees than ETFs, as you're paying for the professional management. ETFs pricing. ETFs are priced throughout the trading day, just like stocks. This means that you can buy or sell shares of an ETF at any time during the trading day. Trading. ETFs are traded on a stock exchange, just like stocks. This means that you can buy or sell shares of an ETF through a brokerage account. Management. ETFs are typically passively managed, meaning that they track a specific index, such as the S&P 500. This means that there is no professional fund manager making trading decisions. Fees. ETFs typically have lower fees than mutual funds, as there is no professional management. Which is better, mutual funds or ETFs? The best type of investment fund for you will depend on your individual needs and goals. If you're looking for a low-cost, passively managed investment, an ETF may be a good option for you. If you are looking for a more actively managed investment, a mutual fund may be a better choice. What are some tips for investing in the stock market? Here are a few tips for investing in the stock market. Do your research. Before you invest in any stock or fund, it's important to do your research and understand the risks involved. Start small. You don't need a lot of money to start investing in the stock market. You can start with a small amount of money and gradually increase your investment over time. Diversify your portfolio. Don't put all your eggs in one basket. Diversify your portfolio by investing in a variety of different stocks and funds. Invest for the long term. The stock market is volatile in the short term, but it has historically trended upwards over the long term. If you're investing for the long term, you're more likely to ride out any short-term fluctuations in the market and come out ahead. Don't panic sell. When the market goes down, it's tempting to sell your stocks and cut your losses. However, if you panic sell, you're more likely to lock in those losses. If you're investing for the long term, you should be able to ride out any short-term fluctuations in the market. In conclusion, the stock market can be a great way to grow your wealth over time. However, it's important to understand the risks involved before you invest. By following the tips above, you can increase your chances of success in the stock market. I hope you learned something today about the stock market and how it can work for you. Please like, share, and subscribe to this podcast if you want to see more useful and educational content. Happy investing and see you next week on Simple Mind Space.